We have Deepak Shenoy joining us of Capitalmind Mutual Fund. Deepak, great having you. Deepak, I'll start off with how you're looking at some of the EMS plays, just given the fact that you've got the mobile phone 2.0 scheme which has come. And that means that there will be an India value add of at least 26 to 30%, for availing of this scheme. How is it looking, and do you believe that we are well placed to execute now on this particular scheme? Only a couple of players out there who can take full advantage of it.
Yeah, I mean, it's early to say. We don't manufacture a whole bunch of components, right, in the mobile phone ecosystem. For instance, the chips, the GPUs, the screens. Well, that part, we can we can manufacture, but we don't meaningfully. We don't manufacture the cameras that go into mobile phones. So, to a large extent, this ecosystem is mostly about assembling stuff. We probably make the cases and the plastic parts that go with it. We'll have to kind of up our component part of the manufacture for us to truly, really de-link away from having to import substantial parts of this ecosystem before we assemble it together. That part we haven't seen much progress on. I think we're building into the assemblers right now, and I think that's an initial good step. But to be really excited about it from a 5-year or 10-year perspective, I think we'll have to get more of the other elements in place, the sensors, all of the other stuff that we actually import. We should be manufacturing or making some of these things domestically. Hopefully, this will trigger a part of that ecosystem to start making new things. The EMS players, right now, since they're relatively small in size, this may add a bump to their near term, next 1 or 2 year kind of earnings growth. But in general, the industry has to move towards more of the larger components being used in the mobile phone units. Interesting, but I think the EMS players have a bigger story here.
Okay. Therefore, how would you play it, Deepak? Would you play it through the component manufacturers and the mobile phone manufacturer, the direct exposure out there?
Yeah, I think no, EMS is fine in the sense of they're useful. They have to still demonstrate, of course, in their earnings that they're able to actually take advantage of these opportunities. So there are a few players here, and therefore, since the field is limited, you have a few players that are listed. There are some unlisted players, some of them very large, who are in this space where we don't get any visibility as public market players. But I think the field will grow. I definitely feel there's a lot more that can happen, but it may not necessarily work for the mobile phone thing as much as it may work for things like auto ECUs, the components, chips, where we actually have some advantage because they don't need the highest end chips. They don't need the most bleeding edge technology to be able to kind of service from India in a larger way. So that may be the scale generating opportunity here, but it may not necessarily be mobile phones. I'm just saying the mobile phone speed is nice, but it's not the most attractive because we can't own most of that ecosystem for a long time.
And Deepak, I'm curious to know, how are you looking at the IPO market? Just the quantum of fresh paper coming our way is keeping our markets sideways, right, to a large extent. Maybe one of the reasons. I'm not saying it's the only reason, but maybe one of the reasons.
Yeah, I think it's a good thing. You see, we don't have to have markets that are going up because there's limited supply of good companies. That is a silly reason for us to. We should go up because earnings are going up, right? Many of these IPO-ish companies have actually turned around significantly since their IPOs, the last 2 or 3 years, whatever IPOs have come. You see, some of them have become quite reasonably profitable. They are growing. They're showing or demonstrating both earnings growth and perhaps the ability to maintain margins or increase their margin profile. That is where it's exciting because you get new companies that are in the growth stage of business rather than maybe existing companies that may not be so growing so much. They may be more mature and not meaningfully doing things in all of the sectors, whether it is retail or whether it is I don't know, eyewear, everything that are companies that have demonstrated or are demonstrating better, profit profiles. So welcoming new companies is important for us. While it may cause initial liquidity to spread to some of these players, I think that is just an initial problem. You want to think of 5 years ahead. All the players that you might know of today that are in the market but not that are in the actual economy but not listed. I need them. We need them to list. The largest exchange in India is not listed. If it does get listed, will it take away liquidity today? Yes, but tomorrow the growth of the market itself will increase in the volumes of the exchange. It will increase in profits for the exchange, and then we can all participate in that growth. Today we can't. So I think that is a good thing in the long term. Not great for the short term, but that's okay because we can allow this, a short-term hitch on liquidity and ride through it. But if we get access to long-term earnings, the better for us as a market.
A lot of sense. What's the sense like with regard to everything that's happening on the macro front, Deepak? You've got the US 10-year bond yield now at 4.72%, which means that FIs coming in becomes that much more difficult at the kind of rates at which we are at. And then there's just lack of clarity, right, with regard to West Asia, with regard to tariff policy, with regard to the way in which India specifically is being dealt with. Just so much to keep track of these days, and all of that is determining the moves on the market.
Yeah, I think to some extent, international debt situation seems to be worrying because the US 1030, Japan 1030, all of them are trading at multi-decade highs in that sense or close to them. India isn't that bad because India's fiscal position is actually much better than it was in the past. And relatively speaking, our yields are much higher than inflation. Our inflation is 4 odd percent. Our overnight rates are 5.2%, 5.525%. So you get real returns of at least 1% even on overnight. But if you add bank fixed deposits, which are at 6.5%, I think you're getting considerably high real rates. So in that context, India is in a better shape, but we will get hit by some kind of worldwide debt issue that happens if it happens. So there is some wariness on that. But macro overall actually looks exciting from an India perspective, not so much from investing abroad perspective, because I think there are extremes that are happening on AI, there are extremes that are happening on debt. All of these things will eventually, if the India story is actually happening and the earnings are showing very robust growth, our credit growth is actually quite good without as much in terms of defaults in recent times, and NPAs are low. So Indian macro is looking at the exact opposite of world macro at this point. So I'm excited about India longer term story. I know that in the short term we will probably take a hit if there's a big issue in the West. But that's okay. I think FIs have been exiting for most of the last 1.5 years. And hopefully when they are able to recognize that India is in a better place, they'll come back, and that will probably add a fillip to us. Macro is where the risk is, but I think the reward will come because India has been in better shape in terms of both debt and in terms of inflation.
Okay. Deepak, I'm going to pause the conversation here. I'm very curious to know as to what you're doing in terms of activity in the market. And I know you can't talk stock specific, but even overall, where we have Q1 earnings firmly behind us. We'll talk about this, but I need to take a very short commercial, come back to you and speak a little bit about that. Stay with us, viewers. Thanks for being with us. We're in conversation with Deepak Shenoy of Capitalmind. Deepak, just trying to understand in terms of any buy or sell, kind of orders that you've placed over the last month or so, and if so, what sectors, what pockets?
So, I mean, our portfolios are run quantitatively, so a lot of the data will tell us what to buy and what to sell. We kind of put layers on top of it. We've noticed, of course, if you see our FlexiCap funds portfolio moves over the last few months, that a lot more has been moving towards small and mid cap, and that was happening, in the last few months. We were large cap heavy, perhaps late last year to earlier this year, and now we've become much more mid and small cap heavy. If you look downstream onto earnings, and that's also something that our data picks up, right? So we drive our portfolios through the data that we that is released by these companies. That the mid cap and small cap earnings growth has been tremendously and much higher. I'm talking 22% plus in mid and small caps on a median level versus maybe 15-16%, which is also quite good for large caps, but relatively speaking, small and mid caps are showing much more growth. Growth is a better determinator of how portfolio positioning should be for us. That growth can come sometimes from the stock price and the movement from market cap itself, and sometimes it will come from the earnings growth that is quite significant. In comparison with the rest of the pack. So our portfolios, you'll see the top few stocks are not even large caps for the most part, and we tend to have a portfolio that changes or morphs over time relatively faster than the index and most of the space itself. So that way we've positioned ourselves more into the mid cap banks, the industrials, and some of the pharma companies. So this is our largest three sectors. So that tends to be where our portfolio is right now, and also the earnings growth on these companies have been considerably good in the last quarter as well. Looking forward to more, of course, but we've not picked anything that is out of these, these more or less portfolios. Of course, our portfolio changes will happen on a reasonable basis. We're not doing anything on the underdog phenomenon where, earnings have fallen so much or growth has fallen so much that we're saying, oh, there's going to be a recovery from here. But we'd like to see that recovery come in the data itself and actual earnings before we try to pick up those kind of stocks.
No, point taken. Deepak, what's the call on gold at this point of time? We've seen a very strong rally, 15% odd. I wonder if you have a view there, and of course, gold financials as a result are up and away.
So I think gold, there are three aspects to it. One is the gold as a commodity itself. I think there's been a strong bear market rally. I say this as a bear market rally because the market fell, I think 25% or so in dollar terms, and then has shown a recovery. Now that recovery has come to a certain extent. I think global bond yields have kind of risen also because of that, and it will take only a small event such as global interest rates rising, interest rates being actual interest rates on the ground. If the US were to raise interest rates, Japan were to raise interest rates, gold would take a beating because that means there is a concentrated effort to beat inflation down. Inflation coming down is negative for gold because gold is used as a hedge against inflation, and to a certain extent, some stability on this global macro policy front will also result in change downwards in the price of gold. Typical gold market rallies have seen 20-30% moves, but I don't particularly feel this is a long-standing rally. I think the prices declining 25% has pushed gold into a bear market, and now it's come back up recently. But I feel the typical charts of gold over the very long term don't show a very exciting time ahead. It's a great short-term move, and using short-term commodities, in a commodity portfolio you'll see some profits, but don't bank on gold as a next 1 year it's going to double, next 2 years it's going to double. I think it's more a long-term hedge against inflation, and that's what you should position it in your portfolio as. Don't look at this move and say, oh, but now we're going to cross like new highs and all that. When it does, I think that's when the potential for a trader becomes more important. But I would say right now, I look at it only as a position that is useful for diversification and to hedge against potential inflationary risks or some kind of macro issues in the long term, not necessarily something great in the short term.
Okay, wonderfully put. Deepak, that's all. Unfortunately, the time that we have, I need to let you go. Thanks so much for coming in, giving us that perspective.
Thank you so much. Thank you.
Thank you.